Hello, ladies and gentlemen. My name is Jesse Colombo, and in this presentation, I'm going to be discussing the U.S. stock market bubble that I believe is inflating at the moment. First, a bit about me. I'm an economic analyst and registered investment advisor at Houston-based Clarity Financial, and I write for its web publication, realinvestmentadvice.com. I warned about the 2008 global financial crisis as a university student, which then helped me to build a presence of over 150,000 followers on social media. I also write a column on Forbes.com about dangerous economic bubbles that are developing today and how they will cause another financial crisis. As you can see from this chart, the U.S. stock market as measured by the S&P 500 is up over 300% from its Great Recession low in March 2009, and it's also 80% higher than its 2007 peak. Unfortunately, this powerful bull market is not the product of a strong, healthy economy, but of an extremely unhealthy artificial bubble economy that will end in a crisis that will be even worse than we experienced in 2008. Other indices, such as the small cap Russell 2000 index and the technology-oriented NASDAQ Composite Index, are up even more than the S&P 500 since 2009, nearly 400% and 500% respectively. To keep it simple, America's stock market bubble inflated because interest rates have been at record low levels for a record length of time. As the chart shows, U.S. interest rates of all types, including the Fed funds rate, 10-year Treasury yields, and AAA corporate bond yields, have been record low levels for the past decade. Ultra-low interest rates help to create bubbles in the following ways. Because investors can borrow cheaply to speculate in assets, for example, cheap mortgages for property speculation and low margin costs for trading stocks. Also, by making it cheaper to borrow and conduct share buybacks, dividend increases, and mergers and acquisitions. Also, by discouraging the holding of cash in the bank versus speculating in riskier asset markets. By encouraging higher rates of inflation, which helps to support assets like stocks and real estate. And by encouraging more borrowing by consumers, businesses, and governments. U.S. monetary policy has been extremely loose since the 2008 financial crisis, and this can be seen in the chart of real or inflation-adjusted interest rates. This is calculated by subtracting the inflation rate from the Fed funds rate. The mid-2000s housing bubble and the current everything bubble both inflated during periods of negative real interest rates. Everything bubble is a term that I've coined to describe a bubble that has been forming in a wide variety of countries, industries, and assets. Low interest rates and low bond yields have encouraged corporations to borrow very heavily in the bond market. Total outstanding non-financial U.S. corporate debt surged by over $2.5 trillion, or 40% from its peak in 2008. U.S. corporate debt is now at an all-time high of over 45% of GDP, which is even worse than the levels reached during the dot-com and housing bubbles. The past three corporate debt booms resulted in recessions, which are the gray bars on this chart. This time won't be any different, unfortunately. Corporations have been using their borrowed capital to boost their stock prices via share buybacks, dividend increases, and mergers and acquisitions instead of making the long-term business investments and expansions that were more common in the past. This chart shows how share buybacks and dividends surged after the Great Recession. During a stock market bubble, traders often borrow from their brokers in the form of margin loans and use it to increase their leverage and therefore returns as the market climbs. This strategy works well when the market is going up, but amplifies losses when the market heads back down. Traders tend to use margin most heavily right around the time that the stock market peaks. Margin debt is the yellow line on this chart, and the blue line is the S&P 500. During the dot-com bubble and housing bubble stock market cycles, margin debt reached roughly 2.75% of GDP. In the current stock market bubble, however, margin debt is nearly 3% of GDP, which is a definite warning sign. Large amounts of outstanding margin debt exacerbate market downturns because traders are often forced to sell their shares to avoid or satisfy margin calls. As a bull market or bubble matures, retail investors become increasingly confident in the stock market and buy stocks more aggressively. Unfortunately, these small investors are typically on the wrong side of the market when it turns. Retail investors currently have the highest allocation to stocks, as shown by the blue line, and the lowest cash holdings, as shown by the orange line, since the dot-com bubble, which is a warning sign that a powerful bear market is ahead. This chart shows the CBOE Volatility Index, or VIX, which measures how fearful U.S. stock market investors are. During both the housing bubble era and the current everything bubble, the VIX remained at ultra-low levels because the Federal Reserve essentially backstopped the markets and economy with its loose monetary policies. Bubbles form when there is virtually no fear in the market. This chart shows the St. Louis Fed Financial Stress Index, which measures how much stress there is in the U.S. financial system. When the index stays at extremely low levels due to the actions of the Fed, it is often a sign that a dangerous bubble is forming. Periods of very low financial stress lead to periods of high financial stress. The financial stress index remained at extremely low levels during the housing bubble era and is following the same pattern during the current everything bubble. High yield or junk bond spreads are another way of gauging levels of investor fear or complacency. When high yield bond spreads stay at very low levels, it is often a sign that a dangerous bubble is forming. It indicates that investors do not have a healthy enough respect for risk. The high yield spread was very low during the dot-com bubble and housing bubble, and it is following the same pattern during the most recent everything bubble. The U.S. stock market is now very overpriced relative to its underlying fundamentals such as earnings, revenues, assets, book value, etc. According to the cyclically adjusted price-to-earnings ratio, which is the smoothed price-to-earnings ratio, the U.S. stock market is more overvalued than it was in 1929, right before the stock market crash and Great Depression. When the market becomes overvalued like it is now, reversion to the mean is inevitable. Another valuation indicator, the U.S. stock market capitalization to GDP ratio, which is the total value of the U.S. stock market divided by the GDP, shows that the stock market is currently more overvalued than it was during the dot-com bubble. This indicator is known as Warren Buffett's favorite indicator, and he claimed that it is probably the best single measure of where valuations stand at any given moment. Tobin's Q ratio, the total U.S. stock market value divided by the total replacement cost of assets, is another valuation indicator that confirms that the stock market is overvalued like it was at prior generational peaks. This chart shows U.S. after-tax corporate profits as a percentage of the gross national product, or GNP, which is a measure of how profitable American corporations are. Thanks to ultra-cheap credit, asset bubbles, and financial engineering, U.S. corporations have been much more profitable since the early 2000s than they have been for most of the 20th century. Since 1947, U.S. after-tax corporate profits as a percentage of GNP averaged 6.6%, but averaged 9% since the early 2000s bubble era. Rising interest rates and bursting asset bubbles are going to hurt U.S. corporate profitability, which is very concerning considering how overpriced stocks are relative to earnings. What is particularly alarming about the current U.S. stock market bubble is the fact that it's driven by a very narrow group of stocks, which means that there isn't a healthy breadth or broad strength behind the bull market. In general, tech stocks have been leading the way, in particular a group of stocks known as Fang, which is an acronym for Facebook, Apple, Amazon, Netflix, and Google. While the S&P 500 is up approximately 300%, the FANGs are up significantly more, with Apple rising by over 1,000%, Amazon rising by more than 2,000%, and Netflix surging by over 6,000%. Today's FANG phenomenon is reminiscent of the Nifty 50 group of stocks that dominated the 1960s and early 1970s bull market. The Nifty 50 were fast-growing blue-chip stocks that led the overall market and were seen as one-decision stocks. The only decision necessary was to buy, because investors thought they would keep rising up, and away as a function of time. Unfortunately, the Nifty 50 proved as fallible as any other investment when they sank during the 1973 to 1974 bear market. Many investors view today's FANGs as can't-lose stocks, just like their counterparts did during the Nifty 50 boom, and are going to be taught the same lesson when the market ultimately turns. So what is going to pop America's stock market bubble? To put it simply, the stock market bubble will pop due to the removal of its fuel, which is cheap credit. Fed-driven economic booms, bull markets, and bubbles end after the central bank raises interest rates to a high enough level. As hedge fund manager Jeff Gundlach put it, the Fed will keep hiking until something breaks. In 2007, it was the subprime mortgage industry that broke first, and this time around, there is a very high probability that it will be corporate bonds, which would then spill over into the U.S. stock market. Because of the growing debt burden in our economy, the interest rate threshold that is necessary to end economic cycles keeps getting lower and lower. This chart shows how the last 2 recessions and bubble bursts occurred after Fed rate hike cycles. It's virtually a guarantee that the current rate hike cycle will also lead to a strong recession and bear market. This chart shows how recessions or financial crises have occurred after historic interest rate hike cycles. A valuable tool for determining where we are in the economic cycle is the 10-year, 2-year U.S. Treasury yield spread. To create this chart, the current 2-year Treasury note yield is subtracted from the current 10-year Treasury note yield and plotted over time. When the spread falls into negative territory, that's when the yield curve is inverted, which means that a recession is imminent within the next year or so. The yield curve inverted before every U.S. recession in the past half century, which is why it's worth paying close attention to. At the current rate the yield curve is flattening, the yield curve may actually invert as soon as the end of this year, which is quite worrisome. At this point, a significant portion of listeners are probably thinking, but how can this market crash? President Donald Trump is making America great again. That's why this market is soaring. Though I actually err on the conservative libertarian side, I do not believe that President Trump can prevent the inevitable popping of the everything bubble that I'm warning about. First of all, this bubble is truly worldwide, so the US president has no control over the economies of China, Australia, Canada, emerging markets, etc. I believe that the popping of a massive global bubble outside of the US is enough to create a bear market and recession within the US. In addition, this bubble was inflating years before Trump even decided to run for office, let alone actually became president. Due to the extreme debt buildup and asset overvaluation, this bubble was destined to pop no matter who was in office. I'd be singing the same tune if Hillary Clinton had won. It's just math. In September 2016, before the election, Donald Trump himself called the stock market a big, fat, ugly bubble. Yet that very same bubble is now 30% larger, and Trump is no longer calling it a bubble, but is actually praising it. Many economic bulls and Trump supporters expect the president's tax reform plan to usher in a powerful economic boom that creates millions of new jobs, causes corporate earnings to soar, which would help to justify today's lofty stock market levels. Unfortunately, this is more wishful thinking than reality. Our economy is far too saturated with debt to grow like it did back in the 1980s during the Reagan boom. To summarize, the U.S. stock market is at extremely lofty levels due to aggressive actions on the part of the Federal Reserve rather than an organic, sustainable economic boom. Booms that are created through the brute force of monetary stimulus never end well despite appearing to be normal economic booms during the good times. We at Clarity Financial LLC, a registered investment advisory firm, specialize in preserving and growing investor wealth in risky times like these. We are based in Houston, Texas, and have over $400 million under management. Please visit myclarityfinancial.com to learn more about us. We are wary of following the overcrowded buy and hold strategy when the market is so overvalued because reversion to the mean is inevitable, but we still use a trend-following investing strategy to make sure we capture upside as this bubble continues to inflate. When we determine that the trend and economic cycle has truly changed, we then shift our clients into highly liquid safe havens that typically rise when risk assets like stocks experience bear markets. Please email me at jesse@myclarityfinancial.com so that we can discuss preserving and growing your hard-earned wealth. Also, please subscribe to this YouTube channel. I will be producing many more videos like this. Once again, I'm Jesse Colombo. Thank you for watching this presentation.